All right, a look at the Asian markets before we kickstart trade for our markets as well. The Asian markets are mixed in today's trading session, and this is after the US markets gained on Friday, reacting to a very strong jobs data. Remember, the US economy added 301,000 jobs for the data time period that it was reported, and this compares with a poll of 170,000 jobs. Stock markets in China, South Korea are closed today due to holidays. Hong Kong will have a half-day trading, but the Nikkei, that one's higher by about 0.3%, and that's despite Sony being down about 8%. Remember, Sony has guided for weak revenue forecast for this year on account of slower sales of the Sony camcorders as well as Sony smartphones. We're seeing some bit of weakness in the dollar yen from previous strength levels of close to around 108. Despite that, auto stocks not doing too well. So what's doing well in Japan? We have Hitachi, which is up around 5.5%. The Korean markets absolutely flat, underperforming the other Asian indices. Keep an eye out on the SGX Nifty. For starters, the SGX Nifty indicates a mild cut, and that's primarily on account of crude. Watch out for crude close to around $63 per barrel, and more important now, post the announcements made in the budget, because remember, the government will be running a tight fiscal ship. With the crude prices moving higher, that will be in focus.
Okay, so that was about China. In fact, a lot of these Chinese and South Asian markets will be shut through the week for the Chinese New Year. But the US markets were up and running on Friday, and the Wall Street ended mostly higher on Friday after a strong jobs report. Now, the Dow rose around 64 points to extend its winning streak for the sixth straight week. S&P 500, that one closed just a tad bit higher, while the Nasdaq Composite declined by 0.25% as the shares of Amazon really fell. On the data front, as Mangalam was pointing out, the US economy created 304,000 new jobs in January, well above the consensus estimate of 170,000. Now, the report follows a 35-day US government shutdown and also marks the 100th state month of jobs growth in the United States. Here is Steve Leisman with the details of the January jobs report.
We got it this morning. The market had digest a massive job growth number, and that's just a day or two after the Fed pivoted towards a more dovish stance on rate hikes. Here's the effect. The bond market gave back some of the strong gains from yesterday. You can't see quite all that yesterday, but you see that it was that it was down about 10 basis, it's down about 12 basis points. It seems to have come back about 7 basis points, and that's after falling yesterday following the Fed's statement. Non-farm payrolls 304. The estimate was 170, so, you know, on or about double. November, December revisions did take off a lot, but it still left December north of 200,000. Average hourly wages, there's one disappointment in there. Unemployment rate, that's okay that it went up because people came into the workforce, and you can see that in the best labor force participation since 2013. Despite the strong numbers, St. Louis Fed President Jim Bullard telling CNBC the Fed should wait and see before hiking rates. And in a separate comment, Dallas Fed President Robert Kaplan says it's very important that the Fed get out of the way here and take no action in terms of the Fed funds rate for the time being. And he suggested maybe through June. Despite these comments, some economists think the Fed will be forced to double back again and resume rate hikes. Over at Pantheon, Ian Shepardson writes, we see no support here for the Fed shift. And if wage gains rise over the next year as much as they have over the past year, the idea that the Fed won't hike further will turn to dust. The recession the market seemed to price for last month was not in the December data. And so far from what we've seen, it's not in the January data either. We'll see, guys, if it shows up in the months ahead.
Okay, so massive beat coming in for the jobs data, but here is some opinion as to what the experts make of it and the impact it could have on the market and the Fed decisions going forward.
Immediate reaction is that this is very strong for this month, but you got this big revision for last month, and you've got some noise in this data. So, broadly speaking, average over the last 3 months sounded to me like that came out to 241,000. That's a very strong jobs market, but we knew that. I think at this stage in the cycle, looking at low unemployment and the jobs growth is maybe a backward-looking signal. We have normalized rates in an environment where our main competitors overseas have not been able to normalize rates. We've kept inflation close to 2%, but now it's time to wait and see how the economy develops. And I appreciated the way the decision came out. So I think we're in great shape right now.
I don't think change their minds in terms of hiking in March. I think that's highly unlikely. And I think that, folks are thinking about June or September, rather, if it's going to happen. But you certainly could see messaging begin to change. I think that's what the market is trying to figure here. Are we going to get higher rates in 2019? I think what you probably need to see is dollar weakness. You did see the dollar begin to flirt with its 200-day on the downside, but I think it does go back to the Fed, because if you don't really get weak dollar, you don't normally see emerging markets really outperforming in a way that's super helpful. You can feel the market trying to understand how to regard the Fed. At this point in December, it was sort of like, we're going to let you cry it out. And then obviously Powell got much more dovish, much more policy driven and sensitive. But now we're going from, well, maybe they're going to cut, to the jobs report was pretty strong, the ISM was pretty strong, pretty big bounce actually in inflation expectations now, pretty big bounce in oil. So is the Fed going to start hiking rates? Are they going to hike once or twice? I don't think the market knows, and I think that's why the strong macro numbers today gave the market a little congestion.
All right, the strong macro numbers from the US also reflected in some gains coming by on the European indices. On the data front, the Eurozone inflation slipped as expected. Last month, inflation slowed to 1.4% in January, and this compares with 1.6% a month earlier. We saw gains come by in the FTSE, the CAC. The DAX was slightly underperforming, and that's primarily on account of a couple of stocks. The largest lender, Deutsche Bank, was lower by about 0.6%, and that's on account of increased merger speculations. And there was one stock called Wirecard, was down 25% in Germany, and that's primarily on account of reports of forgery and falsification of financial reports. So that stock was lower by 25%, which takes the German index or kept the German index absolutely flat. The other indices doing fairly well. In the peripheral indices, the Italian index was lower by about 0.8%. But European markets doing fairly well amid jobs data coming in and ahead of the jobs data coming in. Let's see how they react in today's trading session.
Okay, so this positiveness is not really percolating into Asian markets, because as we suggested, the SGX Nifty is down about 10-15 points in trade. But on that note, we'll slip into a short break. Up next, we'll tell you all the cues and news you need to know for trade this Monday morning. Stay tuned. Well, back home on the Lal Street, it was a volatile session on Friday as the market digested the budget announcements. Now, the Nifty and the Sensex ended in the green, but they were considerably off the day's high. For example, the Nifty was 90 points off the day's high by the time of close. The financials actually underperformed in trade, while the mid-caps ended with 0.5% of gains. But that was about Friday. A lot has happened over the weekend and a lot of important cues to watch out for this week. And Nigel, as always, joins us to tell us the market cues. Good morning, Nigel.
Well, morning, Anisha. Morning, Mangalam. As you all said in the first segment of the show itself, that the US markets, they have been doing well, 6-week winning streak. So that's good news. Today, Asian markets, well, the volumes will be lower because a lot of those markets are shut on account of Lunar New Year. But in terms of our own markets, it was budget day, a lot of volatility in our own markets. The financials, they underperformed because of a couple of stocks, ICICI Bank as well as SBI. They were dragging the Nifty Bank the most, and that's why the Nifty Bank, in fact, ended with a cutoff around 200 points, while the Nifty ended well in the green. A lot of brokerage notes have come out. I'm just quoting CLSA. They say that the budget was a good balance of political and economic priorities. So that's good news. So brokerages, they said, well, this budget is fine. You'll still argue that the Nifty was up close to around 60 points. But I was looking at the bond yields, and that slipped close to around 10 to around 15 basis points odd, telling you that some of those numbers, achieving some of those numbers, whether it's the revenue growth that you're estimating or maybe the direct and indirect tax collections, could there be a cut down in capex expenditure? Those are the fears really that crept into the markets, and that's why we did see the market coming off the high point of the day. But ICICI Bank, SBI, Yes Bank, all of them did see selling pressure. And in fact, ICICI Bank was down 3% odd. Post those good set of numbers, the stock has seen a correction of around 7 to around 8%. Bulk of the losses on the Nifty Bank were account of ICICI Bank, as that graphic plate is telling you. But there was a story otherwise as well. SBI was suddenly selling off. Numbers didn't look so bad. Remember, post-market, we had news coming in on Reliance Communications, and DHFL as well was seeing selling all throughout last week. So it seemed that the street was sniffing something is likely to be coming, and that's why SBI was selling off. Because you're looking at brokerages, CLSA, they're saying that, among the PSU banking space, SBI is the top pick. They have a good target price out there as well. And remember, SBI has exposure to Reliance Communication. That's point number one. And secondly, they've also said that they have exposure to DHFL, and that stock was down close to around 45% odd. So it seems that the street was fearing something else besides the numbers as well, and that's why that stock came off, in fact, close to around 5% from the top. Reliance Communications, they have said post-market hours that the board has decided to implement debt resolution process via the NCLT. So that's going to be important. 270-day window is what we are looking at. And in terms of DHFL, again, it will be in focus because CARE has downgraded its bonds as well as its loans. So we'll keep an eye out on that factor. Besides that, I'm also looking at Zee Entertainment because that stock really sold off, in Friday's trading session. But in terms of positive, GST collections, that was one positive. FIs as well in post-market. Mangalam, you'll track that more closely. Big buy figure coming in terms of cash market. They added some longs as well. And they also bought some calls. In terms of the downside, 10,800, that put has the highest open interest. On the upside, numerous times in the last one and a half month, 10,950 to around 11,000 mark. That should be the area where we'll see some supply coming in there.
Fair point, Nigel. You spoke about the Nifty Bank as well as SBI. All the other stocks that you're watching out for today?
Well, I'll be tracking that clutch again. SBI, I'll be tracking. Numbers didn't look so bad. The street was, clearly fearing something. Was it their exposure to Reliance Communications? So we'll have to keep an eye out on Reliance Communications as well. Now they have filed for the insolvency process. So we'll keep an eye out on that stock. DHFL, they have another con call that's coming in there. The stock is down close to around 45% in the last week itself. So we keep an eye out on that stock. And lenders are saying, there were some reports over the weekend that lenders may come to sell more shares of Zee Entertainment. If that's the case, then we have to keep an eye out on Zee Entertainment as well. So keep an eye out on that stock. In terms of, fairly positive news flow, DHFL Group over the weekend, they've said that 80% stake in Aadhar Housing, that has been sold to Blackstone. So let's see whether or not that can give some kind of a relief to the stock. In terms of the oil and gas space, I'm looking at ONGC. I was looking at, a couple of budget notes, and the oil subsidy has been increased. That could be sufficient for ONGC, and the overhang could come off. So CLSE believes it's a big positive. So we'll keep an eye out on that stock. Results today, Exide, IDBI, IRB, the list should come up for you on the screen. Even SRF comes out with a set of numbers. In terms of result reactions, Mangalam Titan, it was quite a twinkle, I think, so it looked quite good, those numbers. Premium valuations were justifying them, so keep an eye out on that stock. Divi's Laboratory margins nearly around 40%, great going out there, so keep an eye out on that one as well. BEML, Anisha is telling us that those numbers look very, very good, so we'll keep an eye out on that stock. And Godfrey Phillips, well, the tobacco and, that related business did very, very well with a big margin expansion, so keep an eye out on that stock. And results of JSPL as well over the weekend, the stock has corrected from 280 to 130. The numbers look actually a little better than what the street was working with, driven by the domestic steel business. So good going there. And finally, in result related news, Cyient, they have approved a buyback. So we'll keep an eye out on that stock as well, guys.
Okay, Nigel. So that was a long list of stocks that you need to keep on your radar. And thank you for the market setup as well. But on that note, we'll slip into a short break. Up next, Shireen Bhan discusses the SOPs proposed by Piyush Goyal in Friday's interim budget with the man himself. We will get you an excerpt of that conversation when we return. Stay tuned for that.
Welcome back. You're watching Power Breakfast. Now, the 2019 interim budget presented by the Modi government gave a much-needed relief to the distressed agri sector, as the finance minister proposed agri package to the farmers, as well as promised 6,000 rupees per annum for farmers with less than 2 hectares or 5 acres of land. In an exclusive conversation with Shireen Bhan, Piyush Goyal, the man himself, discussed in detail the agri package proposed for the sector. A snippet of that conversation is here.
This is a mark of respect that this nation is paying to our farmers, particularly the small and marginal farmers who have served this nation very honorably. Here we have not kept it linked to the area, to the size of landholding. It's a mark of respect for all those with a holding under 2 hectares or up to 5 acres who will get this benefit once every 4 months. So gradually we are moving farming to 3 crop pattern. And each crop they will get 2,000 rupees. It may help them in their day-to-day small needs, buy some fertilizer, buy some books for their children, pay the electricity bill. The idea behind it is to actually acknowledge the important role that they are playing and to ensure that the very small farmers also get some benefit. If you look at it, this is the first time a sustainable respect has been given to the farming community. Now, let's take a 10-year period. I would be giving out 750,000 crores, 7,50,000 crores to 12.5 crore farmers over 10 years. And how much did all the farmers, what will they get because of the scheme? 60,000 rupees for every farmer, particularly the small farmers,
6,000.
up to 6,000 into 10 years.
Yeah.
I'm talking of a 10-year UPA.
Okay.
We'll be giving this every year, consistent.
Sure.
So it's basically an income support, not that it is, that income is guaranteed, that income is taken care of. We would love our farmers to have much larger incomes. And that is why if you see 4 years, 4.5 years, we have consistently focused on sustainable development. We ensured they all got soil health cards. We started investing in all the incomplete, corruption-ridden irrigation schemes of the earlier government. We ensured that electricity is available to the nook and corner of the country at affordable prices. In every respect, MSP, never before in history, all 22 crops got MSP.
You said that this is a mark of respect to the Indian farmer. Why was this mark of respect not paid earlier then? We've seen farmers protest for the last 2.5, 3 years. We've seen the kind of price collapse that has happened. You talked about MSP, but you do a ground check. MSP is not actually being procured. The procurement is not happening at MSP
As
prices.
I said,
So this has not been something that has been brushed under the carpet. It's been there in public discourse and on public display. So why did it take you till the last
Madam, there are
month
two
of your
aspects,
tenure to
two
deliver on
aspects
this?
to your question. One is about the 5 years. Look at all the actions that have happened over the 5 years. When we did Ayushman Bharat to ensure free healthcare, all these farmers also will get free healthcare. When we bring electricity to every home, all those who are left out would also get electricity connection. When we provided toilets, a mark of respect for the dignity of our mothers and sisters. After all these rural villages, the farmers in these villages, they never had toilets. 1 out of 3 women had the benefit of a toilet in their home.
Right.
Should not somebody answer that for 65 years post-independence? Why did they deprive 2 out of every 3 women from a basic amenity like toilet? Why did they have to lose their dignity that they cannot go to a toilet between sunrise and sunset? What this government has done is a consistent and a very progressive way in which development reaches every farmer, every poor person, every middle class person, and it's a whole journey. After all, what didn't happen for 65 years after independence, we have done twice over in 5 years of one term of the first term of our government.
Okay, so that was the man himself, Piyush Goyal, but we also talked to a lot of architects of this budget. Let's take a look at what they had to say.
Agriculture is a state subject. You need to spur growth in agriculture through a vast range of instruments. One of which is what the government is trying to do. It has done a large number, it has initiated a large number of measures. Pradhan Mantri Fasal Bima Yojana, ENAM, soil health cards, a range of measures were taken, MSP. This is an additionality. The word is Samman. It is giving an additionality to the farmers. Agriculture also requires this, because it's a state subject, states need to do a lot of vast number of structural reforms.
When we got the interim budget of 2014-15, if you see the tax numbers, they were projected to grow at about 19% for direct taxes and 18% for indirect taxes. Whereas our estimation is more conservative. We have just pegged it at 15% for direct taxes and a little lower for indirect taxes. And that is being done to meet our needs and expenditure without raising too much expectations on the tax front. So the number crunching has been done with a lot of care and effort, and I would like to assure you that there is not going to be any slippage on any front. Even this year, whatever we have committed to do, we will do, and we have done it in the past.
Budget is not expansionary at all. The revised estimates are exactly more or less than, despite providing for 20,000 crore. So budget is not expansionary in that sense. The second half implied growth rate as per the CSO advance estimate is 6.8%. That gives you 7.2% because we had in the first half 7.6% growth. So that is what we are sticking to. We have assumed the same thing. For the next year, I think everyone, whether it's the international organizations, the IMF, World Bank and all, everyone is estimating
7.2 to 7.3. Yeah.
7.3 to 7.5%.
I think what we have to keep in mind here is that the process through which the GDP numbers are arrived at. We have a committee of experts that is led by very reputed academics that goes through this process. To give you some examples for how, better measurement and including more, proxies for capturing economic activity. For instance, if you look at the value added for, in telecom.
Yeah.
Earlier, we were using the number of subscribers to proxy that.
Yeah.
In contrast, now we're actually using the number of minutes for usage. So this is an example of the way in which better data is being brought in.
All right, so that was the fine print of the budget 2019. With that, we slip into a short break. Come back, we get you highlights from the numbers reported by a lot of companies. Titan is what we'll discuss on the other side. Keep it with Power Breakfast.
Welcome back. Well, as promised, it's time to shift focus on to the earnings. And Titan, as Mangalam said, reported a glittering quarter. Let's get in more details from Mangalam himself. Mangalam, tell us, how did the numbers look?
Glittering indeed, Anisha, so that was the good part. It ended the budget day with a bit of a shine. At the same time, just take a look at the numbers line by line. The revenue growth, remember the company changed the verses, so the absolute growth is won't be comparable. The revenue growth at 34.3% compares with our poll of 26.7% growth. The EBITDA came in at 584 crores. Our poll was 590 crores. So optically, you would say, that it is below estimates. But then again, the fine print says the company has made an additional provision of 70 crore rupees for its IL&FS exposure. Remember the previous quarter, they had made a 29 crore provision. So far, the provision for IL&FS exposure of close to 140 crores stands at 99 crores. So adjust for that, and the EBITDA comes in at 654 crores. This compares with our poll of 590 crores. The net profit too, 417 crores, above estimates of 409 crores. Let's take a look at individual segments. The jewelry business, 35% revenue growth, 36% revenue growth out there. The EBIT came in higher by 69%. So there was a strong 250 basis points improvement in the EBIT margins for the jewelry business. Watches, the company had told us that the EBIT margin would be substantially lower because they would increase their ad spends. But that ad spends has taken the revenue higher by about 18.8%. That is something that the street will like. Eyewear business too, they are on a path to achieve break-even, and that's what the management said in the conference call. The revenue growth of 43% is something that the street likes. So where does the company stand vis-a-vis its guidance? FY19 jewelry revenue growth guidance was 22%. The company has done 23.6%. Watch margins 15%, pretty much in line. They believe that FY20 will be a strong year given more wedding dates. However, Jan was a muted demand. They would do about 20 to 22% growth in the jewelry business in the fourth quarter. Another management change that came in, CK Venkatraman will succeed Bhaskar Bhatt from October 1. That was something which was in the cards. Bring stability at the top. All the brokerages are fairly positive. Edelweiss has increased their multiple from 50 times to 55 times. That takes their target price upwards of 1100. Motilal Oswal has also raised their EPS estimates, as has CLSA, by anywhere between 2 to 6%. Both of them having target prices of anywhere between 1100 to 1180 on that stock. In fact, on that note, let's take this point forward. Let's cut into the bites that the management had, the conversation that the management had with Rakesh Jhunjhunwala in the earnings call.
Why write off 29 and why not write off the whole bloody thing in one time and finish about it? Why 70 and why not 100 and why not 60?
Do you have information which is better than ours then?
No, there's no question. See, you're making up, nobody knows what's going to happen. So you're making a provision, make the entire thing here. Why, death by one drop, death by one shot here?
No, but, that's a view, but Rakesh, we have to make a considered provision. So we have considered...
The provision does not require you, suppose you provide, it does not inhibit your recovery in any way.
No, it doesn't.
No, it doesn't.
Not 1 rupee.
It doesn't. But I think the issue here is that we cannot provide knowingly more than what we believe is right. Now, the question here is there is not adequate information, but based on whatever intelligence we have, okay, and obviously in discussion with the auditors and what other companies are doing, we made an estimate here, and if again you're right, if we believe in we get more information in March and more provision is required, warranted, we will do it. But as of now, I think this is our considered view, as of now.
Okay, so that was about Titan, but JSPL also reported their Q3 numbers on Friday. The domestic steel business led the operating profits higher, but the margins dropped on a year-on-year basis. Nigel is back with us to tell us what the details are. Nigel, over to you.
Well, JSPL, in terms of a stock reaction, it should be positive. A couple of reasons why. One is that, in fact, the stock is corrected from 280 to around 130. So a lot of the bad news is, appears more or less in the price. These numbers were mildly better. Domestic steel business was good. You had, the power business that continues to struggle, and the Oman business as well, the steel business out there, it did see some pressure. So we're looking at the numbers. The operating profit did come in at more than 2,000 crores, around 2,080 crores as well. Margins at around 22%, more or less stable on a year-on-year basis. While it delivered a net loss this time around, but that was on expected lines. The good part is that the operating profit is nearly 2x what the interest cost is. In terms of this segmental highlights, let's look at the domestic business first. The management has said as of January 2019, the exit rate is nearly around 6 million tons. So that's good news because that's been long anticipated. That's point number one. The JPL business, that's the power business, the PLF continues to be low because coal availability continues to not be there for the company. So they're struggling on that front, and that's why there was margin compression. But that is well more or less on expected lines. While in terms of their Oman business, this time around, they delivered an EBITDA number of around $32 million. Now that's quite disappointing because it's down more than 45% on a year-on-year basis. And I was doing a calculation of the EBITDA per ton. It appears it's at its lowest level we've seen in the last 8 quarters odd. The key trigger for the stock will be how do they reduce their debt going ahead. If they can come up with a way of doing that, then in fact it'll be good for the stock. I expect the stock to open up mildly in the green on the back of a tad bit better numbers than expected. Back to you guys.
All right, Nigel, thanks a lot for that. So we will keep an eye out on JSPL. With that, we slip into another short break. Come back, we talk about DHFL. Get you details of what rating agencies have to say about that company.